In a previous video, I showed you how to calculate a company's book value per share. And if you remember, it's just the company's common stockholders' equity divided by its common shares outstanding, where the common stockholders' equity is calculated as total stockholders' equity minus the company's preferred equity. So this is just the company's net assets minus its preferred equity. Okay, that's the accounting value of the firm. In theory, the book value per share is the amount that each shareholder would receive for each share if all the company's assets were sold for their book values, the company's liabilities were then satisfied, and then the proceeds were distributed to the company's common shareholders. But here's the issue with book value per share. Sometimes you'll have intangible assets that if the company were to be liquidated, let's say it was a bankruptcy and the judge ordered a liquidation of the company, okay, so all the assets are being sold off. Sometimes you have some intangible assets that can't be sold for anything. Okay, they have a zero value in a bankruptcy liquidation. So therefore, for that reason, some people say, you know what, actually we shouldn't focus on book value per share. We should instead look at tangible book value per share. Tangible book value per share is the same thing except in the numerator. Okay, in the numerator, you're subtracting intangible assets. So you've got net assets minus intangible assets minus preferred equity divided by common shares outstanding. So you're excluding goodwill, you're excluding other intangible assets. Think about it. If a company were to be liquidated and they had goodwill on their balance sheet, let's say $25 billion, what can that goodwill be sold for? Nothing. It has zero value. So when you look at the tangible book value per share, you're ignoring some assets that wouldn't be able to be sold for their book value were the company to be liquidated. Now, let's do an example. Let's take a look at Kroger. I'll show you how to calculate their tangible book value per share. So I've actually got two balance sheets here for Kroger. Okay, February 1st, 2020, I have some excerpted information from their balance sheet. I had their total stockholders' equity. These amounts are in millions, so it's $8.573 billion as of February 1st, 2020. They had no preferred equity, so we don't have to subtract that up here. But they had goodwill of a little over $3 billion, and they had other intangible assets of a little over $1 billion as of February 1st, 2020. So what we're going to do, we're going to take the stockholders' equity, $8.573 billion, then we're going to subtract the goodwill, subtract the other intangible assets, and then we're going to divide by, so that yields our tangible book value, by the way, $4.431 billion. Then we're going to divide by the number of common shares outstanding. Okay, 788 million. And that is going to yield the tangible book value per share as of February 1st, 2020, which is $5.62 per share. Now, I did the same calculations for the balance sheet a year later, January 30th, 2021. They had a different stockholders' equity. Goodwill was the same, lower other intangible assets. So they had tangible book value of $5.477 billion divided by 758 million common shares outstanding leads to a book value per share of $7.23. Now, you see that the market value per share, Kroger's stock price, was more than 5 times higher on February 1st, 2020 than the tangible book value per share, okay? That's normal that the market price, you see, is higher than tangible book value per share. In some cases, if it happened, let's say the market value per share instead of $26.86, let's say it was $4. Okay, if it was $4, then a value investor might say, hey, you can get this share of stock for just $4, and the tangible book value per share is $5.62. You should buy that company. You can buy it at basically at a discount. It's a good value. Okay, so that's kind of how this is used. Now, in some cases, the tangible book value per share will actually be negative. Okay, it doesn't necessarily mean it's a bad company or the company's going to go under or anything like that. In a lot of cases, just they have a lot of intangible assets. For example, Procter & Gamble, okay, the consumer products company, June 30th, 2020, we've got their stockholders' equity, then we subtract the preferred equity, we subtract goodwill, we subtract other intangible assets, and you end up with a negative tangible book value on June 30th, 2020. Okay, so it's over negative $17.712 billion. So when you divide that by common shares outstanding, you get a negative tangible book value per share. Okay, negative $7.14. Now, again, I did it also for June 30th, 2021. I used the balance sheet figures for that. And they also had a negative tangible book value and negative tangible book value per share. Okay, so again, that doesn't mean that Kroger was a terrible company or whatever. It's just, look, they have a lot of intangible assets. Okay, they had over $23 billion of intangible assets on June 30th, 2020, aside from goodwill. If you count the goodwill, they had almost another $40 billion. Okay, so this is over $60 billion of goodwill and other intangible assets, which exceeds their stockholders' equity. So it's not that uncommon that you would have a company where you go and you calculate the tangible book value per share and it's actually negative. And again, you just take a look at the numbers and you see that for this particular company, for Procter & Gamble, intangible assets are a significant component of this company's net assets.